Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 55 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you all personal finance topics that I think can really help you push towards financial freedom in your own life. Today, we are going to talk about mortgage types. So the different types of mortgages that you could possibly take out and that you could possibly choose between. And I'm going to put my 2 cents in as to what I think would be the best for most people and the pros and the cons of each of these different types of mortgages because they all have both. But before we get started, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments, ask me questions, tell me things that I could do better, do, whatever in the comments, or if you just have a thought that you want to leave there, that'd be fantastic. And I'll be sure to get back to your specific comment. Also, if you're listening on the podcast on Apple or Spotify podcast, then please go ahead and subscribe there and leave me a review. Also, follow me on social media at MNO with Dylan. And that's a good follow if you're really interested in my content, because that's where you can get a lot of good free stuff day by day to go along with these videos and to hit just on a bunch of different topics that I think I can help you out with just through making those posts and teaching you maybe some new things that you've never seen or heard of before. Also, if you want some help one-on-one, if you want somebody to help you build a financial plan for you that's specifically tailored for you, I can help you with that, but you just need to go to my website, www.mnowithdylan.com, and click on the Work with Dylan tab and select the type of financial coaching service that you would prefer, and we can definitely work together and help you push towards financial freedom in your particular situation. So let us jump right in, no reason to delay. There are basically 4 types of mortgages that I'm going to cover today. There's the conventional loan, there's the VA loan, there's the FHA loan, and there's the USDA loan. I know that's a lot of acronyms for everybody out there. It's a lot of acronyms for me. But we're going to go through the pros and cons of each, kind of tell you what each are, and then at the end I'll kind of give you my thoughts on what would be the best for most people and what you should stick to in most cases. So, conventional loans. A conventional mortgage or conventional loan is any type of home buyer's loan that is not offered or guaranteed by some governmental entity. So what does this mean? This means that these types of loans, they're not backed by any kind of housing administration. They're not backed by Veterans Affairs. They're not backed by anything. They're just these loans that banks make to individuals, and the bank is on the hook for the loan. So the pros of the conventional loan. So down payments on the conventional loan are as low as 3%. So that's a particular pro. Although I do want you to put as big of a down payment on a home as you can. For those that may be first-time home buyers, down payments as low as 3%, big deal. Also, no PMI if you put down 20%, which is fantastic. That's another reason why we want to put a big down payment, so we can keep from being in that PMI. But if you do happen to fall within the PMI, let's say you're a first-time home buyer, you can only put down the 3% or 5% or whatever, then another pro to this is that PMI can be canceled and automatically removed when your loan-to-value ratio, meaning the amount that you owe over the market value of the home, is at 78% or lower. So if you can get down to that 78%, then PMI can be canceled. And then something that I don't see as a pro, but others definitely can, is that this type of mortgage, this type of loan can be used for second homes and investment properties. And we talked earlier this week about how I don't want you to finance your investment properties. I want you to purchase them in cash, and even more so with a second home. Like, don't pay off a home and then just go right back into mortgage debt on another home. Don't do that. So make sure that we're buying those things in cash. But that's a particular pro of this type of loan, because you can get them on those types of properties. Then we jump to the cons. So there are definite downsides also to the conventional loans. One being, if your credit score is lower, rates go up pretty handily. So the difference between a high 700s FICO score and a lower 600s FICO score can be upwards of 1.5% on your rate, which can turn into a ton of interest over time. So that's a big con, especially for those with lower credit scores. That can really eat away at them. Also, income limits are had on these particular types of loans. So they have really soft debt to income ratios. And so what I mean by that, typically they require 28, and they call it front end DTI. And all this means is that on the front end, right, on paying your loan, right, you need to have your mortgage payment to be no more than 28% of your income, right? So they kind of take care of my particular stringent guideline by itself, right? And then on the back end, it's 36. And what that means is all of your other debts don't need to be more than 36% of your income. So on your debt to income, it doesn't need to be more than that 36%. And so that's a particular con. And then there's also really tough credit guidelines. So credit scores that are below the 620 number, that's a big barrier in the financial world, is that 620 FICO. Anything below that 620 FICO, you're not likely to get a conventional loan. So that's a con to the conventional loan. And then also reserve money is needed after a down payment. And this is particularly awesome in the fact that I tell you to have an emergency fund before you go and purchase a home, because if you need this reserve payment, you have it. All this is that banks will typically require about 2 months of mortgage payments to be saved in some kind of checking account, savings account. You have to prove that you actually have that money. That way, you can prove that if something does happen, you can make the payments for some period of time. And so luckily, if we have an emergency fund, that should already be taken care of. But that is a con to this loan because that is a restriction, something that has to be had. Now we'll move to the VA loan. So the VA loan is offered by the United States Department of Veterans Affairs, the VA, right? And the VA sets the qualifying standards, and they dictate the terms of the mortgages offered, and they guarantee part of the loan, but they don't actually offer up any money to finance. It's financed by private lenders, such as banks and mortgage companies and things like that, and they just guarantee the loans for those banks, at least a portion of the loans. So let's talk about what the pros of these are, what the cons of these are, and kind of think about if you are able to get one, because just about anybody can get a conventional loan. We didn't have any restrictions on who you were or what your income is or whatever, but there are more stringent guidelines. But for the VA, the pros to the VA, no down payment required. So you don't have to have a down payment for the VA, but that doesn't change the fact that you're gonna have to pay for that whole mortgage. So obviously having a down payment is still a positive, even if you do qualify for the VA loan. And then no PMI, which is a big deal, because let's say you can only put down 3, 4, 5%. You don't have to pay PMI, which that's an awesome benefit as well. And then easy credit. So there is no minimum credit score. There's lower interest rates and higher debt to income ratios than the conventional loan had. So you see all these benefits really stack up. But see, the problem, just like as we've talked about before with like tax advantaged investment accounts and things like that, that anytime that you get some kind of benefit, it's likely going to be followed by some kind of restriction. And we will see what that restriction is here shortly. So one last pro is there are no prepayment penalties. Some mortgages do have prepayment penalties, meaning if you do go about paying it off early, there may be a penalty to that. We don't want mortgages with that. We want mortgages that we can actually pay off early and not be penalized for that. But there's no prepayment penalty here. Now the cons. So with the conventional loan, we said, okay, you could do the second mortgage or the investment property that could have a conventional loan on it. But with the VA, it can only be for your primary residence. So that's a particular con. Then a big con to the VA loan is the VA funding fee. So this is a fee that's required up front, and it's very costly. So even though they're taking away the PMI and the need for a down payment, you are having to pay this funding fee, which can be quite substantial. Then the closing for a VA loan is actually slower than the conventional loan. So this may take an extra 2 to 5 days because it's more complex. And some sellers are not interested in accepting a buyer that has a VA loan for one reason or another. And then the biggest con, the biggest restriction to the VA loan, I said what earlier? I said it was from the U.S. Department of Veterans Affairs. Well, what are veterans? Those are our service members, our military, our people like that, our reserve military, things like that. And so those individuals are the ones who can get this mortgage. It's not for everybody, okay? So active duty military, reserve military, military veterans, they can potentially qualify for the VA loan, but the normal individual, the normal civilian could not just get a VA loan. So you see that there are these restrictions that come along with the good things. And so that's just how it is in the financial industry. You'll just find that anytime you start seeing some type of benefit, then look out for the restriction that comes from that benefit. Be very skeptical of benefits that are abnormal, like no PMI, like no down payments, things like that. So we see those distinct differences between the VA and the conventional loan. Now, let's tack on another type, and that other type is the FHA loan. And this FHA stands for Federal Housing Administration. This is a mortgage that is insured by the FHA, and they are issued by an FHA approved lender. And so they're designed for typically lower to moderate income families or lower to moderate income individuals. They do require a lower down payment and lower credit scores than many conventional loans. So you see, again, benefits. So let's watch out for the restrictions. They for sure will come. So what are the pros to the FHA loan? So the pros, a low 3.5% down payment. So some conventional loans do require 5%, and so these FHAs only require 3.5%. And then for lower credit borrowers, they offer better rates than the conventional. We talked earlier about how the conventional, there can be a 1.5% spread between the higher credit score individuals and the lower credit score individuals. And that won't be necessarily the case with the FHA loan. And there's more lenient credit score guidelines. So a FICO as low as 500, which is a pretty, that's getting into scary territory with your FICO score. If you have one as low as 500, but you do have 10% down, you could potentially get an FHA loan because you prove that you can, save money and have the money to do that. And then another pro is lower mortgage insurance rates than the conventional. So the mortgage insurance that we were talking about earlier, the premium will be 1.75% up front on the FHA, and then 0.45 to 1.05 annually from there on. And like I said, it will be more with the conventional loan. Now, the cons to this loan become readily apparent very quickly. The mortgage insurance is not cancelable. And so think about why they might do that, make it to where you cannot cancel the mortgage insurance. And that's if you put less than 10% down, then it will last the life of the loan. Why would they do that? Well, they're already putting the mortgage out there for lower income individuals. They're putting it out there for lower credit individuals. They're putting it out there for people who don't have a lot to put down. And so all of those things are a good mix for people who may not be so good at making their payments. And so they want to make sure that they are insured, the lender does, against the individual defaulting on the mortgage. And so how can they ensure that? Well, it's this mortgage insurance premium that the individual will pay. Now, what you can do with the FHA is you can refinance to a conventional to get rid of the PMI, but obviously refinances are costly as well. So that's a big cost associated with the FHA if you don't have enough down at the beginning. And then as far as FHAs go, you know how I said the VA, it had to be your primary residence. It couldn't be a second home or anything like that. Well, the FHA is very similar in which it has to be the owner-occupied home only, no vacation homes or investment properties. And for some reason, many condos are not approved, and it has to do with like insurance concentration limits, owner occupancy percentage limits, things like that. That are just very technical, but good to know about an FHA loan and knowing whether or not you could actually get one. And then a last con is that loan limits are based on region. So you're only allowed to get a certain percentage of a typical conforming loan based on the region of the U.S. that you live in. And that's a really weird thing and a really weird restriction to put on individuals. And so the big restriction there, the big one that you need to keep in mind is the PMI, is the mortgage insurance that you have to keep, and that's just such a big disadvantage to both the VA and the conventional, but especially the conventional, to where you may have to pay PMI at the beginning, but then you can actually get rid of that PMI when you can't get rid of it with this particular type of mortgage. So that's a really tough thing. And it can be difficult to get over if you do have an FHA loan. And you just see how with individuals who don't seem as creditworthy or don't have as high of incomes or whatever, or don't have as high of down payments, they're making them pay in other ways to make sure that they'll continue to make their payments and prove themselves creditworthy. Which is just the case with those FHA loans. It makes sense, but at the same time, they make it really costly for people who don't need their home to be really costly. They need it to be less costly. So you see that there. You see the pros and cons. We move on. So the last type of loan that we want to talk about is the USDA loan. And when I say USDA, I'm not talking about your beef. I'm not talking about what you're buying at the supermarket. No. The USDA home loan is a zero down payment mortgage for rural and suburban home buyers. So it makes sense, right? Rural or suburban home buyers, right? And the USDA loans are issued through the USDA loan program, also known as the USDA Rural Development Guaranteed Housing Program. And it is backed by the United States Department of Agriculture, which is USDA. So what are the pros and cons of these loans? Well, pretty simple, right? I already said one of them. One of them is there is no down payment for the USDA loan. So that's a pro. And then there's also no prepayment penalties, which, like I said earlier, we don't want prepayment penalties because we want to pay off our mortgages early. And in order to pay it off early, we need to be able to prepay. We need to be able to pay before it is due. Okay, so that's a big deal. And then with USDA loans, there's a pro that I would not suggest, but it is a pro, and you can finance the closing costs. Be able to pay for your closing costs. Don't finance your closing costs or put it in with the rest of your loan. That's just not going to benefit you in the long term. So I would just suggest not doing that. But it is a particular benefit that is had in the USDA loan. And then also in the USDA loan, fair credit is okay. So they're not going to be far too stringent on credit like the conventional loan may be. And then they're also low fixed rates. So the mortgages are not adjustable rates typically, and they're really low and affordable rates that are backed by the USDA. And then you go into some of the cons. So you've got a couple big pros there, less stringent on credit, no down payment, no prepayment penalties, all these types of things. Then what are the cons? Well, it's restricted to rural areas. So if you don't live in a rural area, you're not purchasing a home in a rural area, you likely cannot get these USDA loans. They also have maximum income limits. So the FHA loans have something similar, but the USDA loans, you can't make more than a certain amount and get this type of loan. And like the FHA, the USDA also requires that you have the mortgage insurance premiums being paid consistently, and that is a requirement. And it's also only for single family homes. So that's a con as well, even though I don't want you to be mortgaging your second home or your investment property or whatever it may be. So you see, again, that they give you these good things, but they also make you pay for it on the back end. So just because things have particular advantages don't mean that those advantages outweigh the disadvantages. And so that kind of moves us into talking about, then there's so much stuff we just went over. There's so many advantages, pros and cons, advantages, disadvantages. Then what's the best? What is the type of loan that we need to choose? And my personal opinion is that the conventional loan is the loan that most individuals should strive to get, should try to get, because it is the most popular, first off. And the reason it's the most popular is it's the least costly in the long term. And we'll talk about why. So this type of loan does have several things that make it attractive to potential borrowers, one of which is low interest rates. And yes, that's going to require that you have better credit in order to get those lower interest rates, but lower interest rates nonetheless are very advantageous to borrowers. So lower interest rates, fast loan processing. When you're ready to move, you're ready to move. You don't want to have to wait on a loan, or your deal may fall through. So the loan processing is actually faster with the conventional loans. Then you've got diverse down payment options. Like I said, they can be as low as 3% of the home's price. Sometimes they're 5%, something like that. But you don't have to have a crazy amount down. And you would have to pay the PMI if you don't have 20% down. But at the same time, you can get out of it. You can get out of the PMI and it can be automatically dropped for you with the conventional loan. And that's not the case with the FHA. That's not the case with the USDA. Those things are required. You have to refinance your way out of them. And then there's various lengths on a fixed rate mortgage ranging from 10 to 30 years. So all of these different mortgage types don't have the 10, 15, 20, 25, 30 choices that conventional loans do have. You can find conventional loans in just about any increment of 5 from 10 to 30. And so that's an advantage because you can choose your length. Obviously, we want that length to be shorter. We talked about that yesterday. But that said, you do have that flexibility to choose with the conventional loan. And then obviously reduced PMI. So the fact that we can reduce the PMI down, yeah, it's costly on the front end. It's more costly than the FHA's requirement on the PMI. But the FHA has to keep the PMI. You don't have to keep the PMI once you get over that particular loan to value hurdle. And then because conventional loans offer so much flexibility, there's still some decisions you have to make even after you choose this loan type. So you also have to consider, how much you can put down, how long you want your term to be, and how much house you can afford. Obviously, all these things that we've talked about previously. But they don't make this a bad mortgage choice for you. This is still a very good choice. And so those are some reasons why the conventional is good, but why not the others? Some of the others had some really good benefits, right? So why not the others? Well, the VA, the processing fees are high, and it's only for veterans. So first of all, being only for veterans cuts a ton of people out. And then the high processing fees actually are something that people are okay to live with sometimes because, they don't have to put, as much money down as you do with the conventional. You don't have to deal with the PMI, those types of things. And so if you don't have to do those, then you're okay with this. But those fees are so high, they do end up eating into your ability to pay your home down faster. They do cost you just as much, if not more, as the PMI on a conventional loan is going to cost you. But the restriction to just veterans is a tough thing, and it takes longer to process. It's a more complex loan. So the VA is probably not the best idea unless you don't have really great credit and you have the financial situation actually to buy a home. You're in that place in the financial action plan where you're ready to buy a home, but maybe your credit's not great and you are a vet. The VA might be your choice, But for most individuals, I would pick the conventional over the VA. Then with the FHA, it's pretty glaring why I don't like the FHA, because the FHA is for typically lower income individuals, and what they do is they make you pay for the fact that you don't seem very credit worthy. And the way they do that is through PMI not being flexible and it being for lower income individuals. So if you're already low income, you probably want your housing costs to stay low. But what the FHA does is actually, makes you pay this PMI and keep it for the life of the loan, which makes the cost of your housing more expensive than it could have been. So if you can get a conventional loan, you should. Obviously, like I said previously, you need to be in a position where you have an emergency fund and you're out of debt before you go about purchasing a home. So hopefully, even if you do have a lower income, you could qualify for a conventional if you have adequate, borrowing standards. But if you have to take out an FHA loan, it's not the worst thing in the world, but you might end up refinancing into the conventional later if it's not too costly to do so. So that's my thought on the FHA. Then the USDA income limits and rural area restrictions. So the fact that you have to keep your income under a certain amount to get this type of loan. We want to increase our incomes. We don't want to keep them down. So that's a strike against it already. And then not everybody wants to live in a rural area that would qualify for this. It's probably going to be a little more difficult to qualify for, given the fact that you do have to live in specific areas. So we don't want to fall into that. So I think if you can have the adequate income to or the adequate credit worthiness to apply for a conventional loan and get a conventional loan, that you should definitely do that over the USDA loan. And then just like investments, like I've said a couple times already in this video, anytime you get a benefit, then you're paying for that benefit. And mortgages are no different, right? So the one that offers and it's kind of a weird thing, the one that offers the least gimmicks, right? The least no down payment, low rate, no PMI, all these types of, gimmick type things. The one that offers the least of those is probably the one you want, because you're paying for all those other things. You're paying for, no PMI on the VA loan because you're paying that processing fee that's so high on the VA loan. Also with the FHA, you don't have to have as high of credit standards, but you're keeping the PMI the whole time. Or the USDA also keeping the PMI the whole time, income limits, living in rural areas, all these types of things that are just restrictions to you that you don't need. They're unnecessary restrictions. So don't give up things that are good, right, in return for having to pay for them in unnecessary amounts. Do the cost benefit analysis. See what the cost would be of these different types of mortgages for yourself. Find one that's going to be the lowest cost and the most beneficial to you over the long term. In most cases, it will be the conventional loan. So I do push you to try to get that conventional loan, even though the borrowing standards are a bit higher. But if you're out of debt, if you've got an emergency fund, if you haven't ruined your credit, then your ability to get that type of loan shouldn't be ruined, and you should be able to get that and move forward with a lot more flexibility than these other types of loans. So I hope that this episode was really informational for you guys, and that it could help you to understand these different types of mortgages and see why I suggest the conventional loan and why that may be the best relative to these other types of loans that there are out there. Because I know we all hear them. We hear VA loan, FHA, conventional, USDA, all these types of things. And you're like, what the heck do they mean? I hope I cleared that up a little bit. I hope I wasn't too unclear in this video. So just make sure that if you have anything that you can think about that I didn't go over here and you're wondering, just drop that in the comments for me. That would be fantastic. Also, go ahead and subscribe to my channel if you have not already. Like this video if you think this was good information. And then if you're listening on Apple or Spotify podcasts, go ahead and subscribe there and leave me a review. Follow me on social media at MNO with Dylan. And then if you want to work with me doing financial coaching, if you want me to coach you through a financial plan that will work for you, we can definitely do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can pick the financial coaching session that is right for you, and we can start working together as soon as you would like. So that's just something that I like to leave on the table, because a lot of people do need individual help, and I am here to help. So tune in on Monday as I talk about refinancing your mortgage and when it is proper to do so. And also check out this weekend, because tomorrow I have 3 MNO clips coming out, and then I have 2 on Sunday. That's how it is every week. They come out at 10, 1, and 4 on Saturdays, and they come out at 11 and 2 on Sundays. So be looking for those, and hopefully you can catch on to the things that you may have missed in this week's videos. So thanks for tuning in to this episode of Money's No Object. I'm your host, Dylan Howell. God bless.